Hey, welcome back. After some pretty eventful couple of weeks, Google is now down over 10% from its recent all-time high. There are a couple of reasons that I'll get into in a minute, but I see many people referring to this as a potential profit taking from high-growth tech, especially AI, and moving the money into safer value or dividend investments. And indeed, we can see this kind of stock moving in a pretty opposite direction, and if this keeps up for a couple of months, we might be looking at potential buying opportunities. So let's begin by looking into Alphabet. In Q2, we can see that the problem isn't that they aren't growing. They actually developed very well, with a 14% increase in revenue and better margins. The problem is that the market expected more, and this is very common especially with tech. They expect the second half to have a few issues with the high end of the margin, but not something significant, and again, we can see this focus on the short term. With Google especially, I think the market will always be hyper-fixated on every single piece of news and report and so on, even if it's only some short-term thing. You probably remember the small back and forth they had with Microsoft around AI when one would increase if the other had trouble with the technology. Again, it's often not really that important in the long term. Now, we see probably a shift from tech and especially AI into more stable value/dividend investments, so at some point growth tech stocks might become an opportunity. Something impressive that might deliver a lot of growth in the future is the cloud business. We can see an over 25% increase in revenue, but even more impressive is the operating income that pretty much tripled. As they are developing it, this could become very profitable in the future, and then you have other bets, including AI, that can become additional growth engines for the company. They can make even as much as 70 billion, which puts them at a ratio of around 30, which is pretty much the average for Google. The cash flow grew significantly, and we can see the stock following it over time. So we should probably see it move similar to the earnings or the cash flow in the future, meaning that a potential slowdown could also lead to worse performances. Still, so far very impressive growth, and with AI and other trends plus the way the company expands, I think there is potential to keep seeing good growth. Financially, they are in a really good shape, with the cash equivalents and securities alone being pretty much enough to cover all the liabilities. You get about 280 billion in equity, but for tech in general, this is not really relevant. Still, a very good financial shape, and given how much money they can make, going bankrupt is almost impossible. We can see this financial health with pretty much all the big tech companies, and it's kind of the norm among them. The thing with Google and other big tech stocks is that it's very hard to find them at what you'd normally consider a cheap valuation. Unless they somehow become completely terrible companies, something like 10 times the free cash flow is like a once in a decade thing to see. I think Meta was there when they crashed 80% recently. You either get kind of a floor at like 20 times the cash flow, or they crash significantly because of the way the market works. You know, either there are some slight issues and you still have a lot of funds and institutions buying when they see it fall in the low 20s, or the general sentiment is very pessimistic and they don't want to touch it. Again, Meta is the perfect example when they had all the metaverse uncertainty around them, which might still be a waste of money, by the way. Another thing that might support this generally high valuation is buybacks. Google is spending almost all their cash flow on buybacks, which got to a very significant level. They spend around 80 to even 100% on buybacks, so the higher the cash flow, the more they buy. The 5-year average cash flow growth rate is around 20%, but let's say they grow it at 15% over the next half a decade, which is a lot, but with AI and cloud growing, it's not impossible. That means they basically double the cash flow, leading to potentially something like 120 to 140 billion in buybacks. For this market cap, that's around a 5.5 to 6.5% yield. It isn't a lot, but buybacks are different from dividends because they often have a positive effect on the price, which is what Alphabet wants. Dividends would actually be bad because they are discounted from the price. Something else with the buybacks is that by inflating the stock price, it gets cheaper for them to do acquisitions. That's what the Class C shares were made for, by the way. They have no voting rights, which is what makes them different from Class A. That means the more they grow, the more they can use the stock to develop the company, which is what pretty much all the big tech does. This is kind of, let's say, the secret recipe behind their compounding. When you can use so much external capital that comes with zero interest, so basically free money, you can imagine how well you can grow, especially if you have a company that's already making good money. You just keep adding to the underlying profitable business, like Meta with Instagram for example. So yes, you often overpay for this type of company, but you know that they actually use that to their advantage. As for a valuation, this is gonna be a matter of growth plus the effect of buybacks. In a negative scenario, let's assume they grow at 8% per year, which would be a huge drop from what they normally do. You know, maybe some regulatory pressure or high competition could result in something like this. In half a decade, that's around 101 billion. Assuming a ratio of 20, since this would be a disappointing amount of growth, that's a market cap and the price close to the current ones. So pretty much a break even, but you have to take into account the buybacks. There is no exact formula behind it, but assuming that they add their value to the market cap and they pay around 80%, that's around 350 billion, so a market cap of around 2.35 trillion. That's basically a 10-15% profit in half a decade, which is not good but also not terrible for such a scenario. In a second one, let's assume a 12% growth rate, which is kind of low for them, but I'd rather be careful. That's pretty much 121 billion, so not very different, but the ratio would be different. Assuming the ratio at 25, which is still below average, that's a market cap of 3 trillion. Paying 85% as buybacks with a ratio of contribution to the market cap of 1, that's 3.44 trillion. That would be a price of around 281, so around a 65% profit. Again, not some incredible amount of money, but would probably be in line with the market's average. Now, in a good scenario with AI and cloud supporting their growth, let's assume a solid but still relatively careful 15% growth rate. That's 138 billion, which again isn't a big difference because it's only half a decade, but it's about how the market would react to it. If they can develop like this, which is still very solid for such a big company, let's say the ratio is at 30, similar to the current one, meaning 4.14 trillion. With 90% buybacks adding the same value to the market cap, that's 4.62 trillion. That would be a price of roughly 377, so a 120% profit. Now, sure, the buybacks can add 2, 3, 5 times their value, but also nothing, and the market can always get pessimistic. Overall, I like and I own Google, but this is a bit too much to call it a buy in my opinion. Any slowdown or issue would result in a significant crash, as we saw with the Q2 report. This is why, even with the potential from AI and other trends, I think it's better to assume a growth rate of something like 10-12% and then see if I'm happy with the current price. I think something like 120 to 140 should be okay for me. You know, a bad week or month can easily get them to that level. Now, from a business perspective, this is a really good company. Very good financials, lots of profits and cash flows, plus a good management that knows how to use the stock to benefit the company. At the time I'm recording this, we keep seeing Nvidia, Dell, Microsoft and even Google fall in what might be the AI hype losing a bit of momentum. Maybe if we continue to see this shift from growth to dividend or value investments that we saw recently in the market, tech might become the next investing opportunity. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.